everybody. Thank you so much for joining us. My name is Samantha Seguenza, and I'm in Client Services here at the Retirement Group. I am going to be moderating this webinar. You'll see me throw some very valuable resources into the chat throughout the presentation. They will guide you to our Education Center, where you can view a full library of all of our past AT&T focused webinars, as well as a link to book an appointment with an advisor after this presentation. And the last thing you'll see me throw in is a link to LinkedIn, where you can follow us and get all of the updates of our upcoming AT&T webinars and presentations. Today, we're going to be talking to you, as you may have learned, that AT&T has made some changes to the PBGC coverage for AT&T pensions. Our AT&T focused advisor, Tyson Mavar, will be coming on shortly to speak to you about those changes and give you all the information that you need so that you can make an informed decision about your financial future. Before I bring Tyson on, I need to just remind you that although we have extensive knowledge of AT&T's retirement plan, and although the Retirement Group has over 30 years experience working with both active and retired members of the AT&T community, we are not affiliated nor endorsed whatsoever by AT&T. The Retirement Group is a completely independent group of financial advisors. And after Tyson's presentation, I'll be coming back on with him shortly to answer any questions you may have had. Feel free to enter them into the Q&A box. It's completely anonymous, and Tyson will answer as many as possible before we end today. And with that, I'd like to introduce you to our speaker today, Tyson Mavar. Hi, Tyson.
Hi, Sam. Thanks, everybody, for joining us this afternoon. My name is Tyson Mavar. I'm one of the AT&T focused retirement advisors for the Retirement Group here in Texas. And as Sam mentioned, today we're going to talk about some of the recent changes in the AT&T pension plan that doesn't affect all employees. In fact, many of you that are still working at the company may not be affected at all by this, but it's an incredibly important issue that needs to be addressed, especially if you have not yet taken your pension from AT&T, you haven't decided how to take your pension, because this is a risk that we have been concerned about for many years. And one of the reasons many of our clients have told us that they've decided to take the lump sum on their pension because of not knowing who's going to be paying that pension liability for the rest of their lives. Before we talk about some of the changes, those of you who aren't as familiar with our company, the Retirement Group is an independent financial consulting company that specializes in working with corporate employees. AT&T happened to be one of the companies that we've worked with employees for the longest, a little over 30 years. We have many clients across the country that have retired from AT&T, also some clients that are still working at AT&T. And our hope is to educate folks on some of the important decisions as they approach your retirement, so that once they get to retirement, they feel that they've done their due diligence and don't have any regrets with any of these financial decisions, as there are many, especially with the AT&T benefits plans. There's a variety of ways that we can help you, even if you're not yet a client of ours, on a complimentary basis even. The cash flow analysis is probably where you will get the most help and value if we run a retirement projection for you. Again, a complimentary service usually takes about 15 to 20 minutes to go through the plan in person or on a web meeting. So let us know if that's something that you're interested in having us do. Or if it's been a while since we've updated your retirement analysis, now is probably not a bad time to be updating that with the changes to interest rates that we've seen in the last year, changes in retirement tax laws, the changes to the AT&T pension, and a variety of different benefits, including the health plan in the last couple of years. We want to make sure that that plan is up to date so that we can account for how these changes are going to impact the sustainability of our plan, and if there might be some suggestions that we would have to improve the probability of success as you approach your retirement date from AT&T, or at least your transition from AT&T, even if you are going back to work after you leave the company. So first, let's talk about the pension plan so that we can start to understand how this plan has changed, some of the important considerations on the decisions as you get to that time where you're leaving AT&T and have decisions to make. The pension, there's many different plans, as many of you know, with all the mergers and acquisitions over the years and the changes that AT&T has instituted on their pension benefits. If you're a manager especially, you may have one of a number of different pensions. The non-bargain program is the most common pension plan that we run into. However, we have many clients that are Legacy T and who are on the ALM plan, the AT&T Legacy Management Program. If you are a non-management employee or craft employee, as we say, your pension will be a function of the region of the country that you live, or at least that you started your career within, a Southwest program, Midwest program, West program, so on and so forth. So many different pension plans, but let's talk about some of the important issues with each one of these plans here and some of the important things that we discuss with our clients as we're approaching their retirement and putting together that plan originally. So a craft plan, very easy to remember. It's just based on your pension band, which is a function of your total income or compensation with the company on an annual basis. And that could have changed over time, but your pension band is going to create a monthly annuity. It's also a function of your years of service with the company. You may have some age penalties if you did not work until 55, or if you left the company prior to having 30 years of service, there's a possibility of some age penalties. And once they calculate that monthly annuity, they can convert it into a lump sum payout using your life expectancy when you commence your benefit. So not necessarily when you retire, but when you start your pension, they're going to look at your life expectancy as well as the current interest rates, which many of you know change annually. These interest rates that are based on corporate bond interest rates, when they go up, the lump sum payouts go down for almost all pensions. Not all pensions, though. There are some cash balance plans that when interest rates go up, your pension lump sum is unchanged. In fact, it actually grows at a faster rate moving forward. And we ran into a lot of people that were worried last year when interest rates were going up that they were going to lose a large sum of money on their pension plan, when in fact they were on the cash balance plan and they were not affected by the rate changes. On the other hand, many employees that did not leave the company by the end of the year and who lost a lot of money, and also many employees who left the company purely for no other reason than to avoid losing money on their lump sum. Some of the most important conversations we have with people approaching their transition from AT&T, picking the best day to leave to maximize what you walk away with and minimize your risk of running out of money in retirement. Now for managers, there's many different pension plans, but there was some changes that happened in the late 90s where the company went from a cash balance program, and for most managers, the exception being the Legacy T folks, the folks that have the ALM program for their pension, they moved over to this career average minimum formula, or CAM plan as it's known. And what this is called, if you log into Fidelity Net Benefits and you look at your pension plans and you have what's called the non-bargained program, this is the pension that's referring to, the career average minimum pension formula. So let's take a look at how this plan works. The first thing you want to know, and we're going to zoom in here a little bit. There we go. You can see here, many of you have heard the term and might by now be familiar with something called the modified rule of 75, or mod 75. That is a way that you become service pension eligible. Now, it used to be even more important because it came with some retiree medical benefits, but now most managers do not even have retiree medical benefits unless you were grandfathered in by a number of different ways. So for those of you that are still working, reaching mod 75, for the most part, is only valuable in terms of what it gives you on your pension. So there's actually 4 ways to become service pension eligible. You can get 30 years of service, regardless of your age. You can get 75 points of age plus service that has to be achieved in one of 3 special ways. So let's go over the 3. Be at least 50 years old with at least 25 years of service. Be at least 55 years old with at least 20 years of service. Or be at least 65 years old with at least 10 years of service. If you meet any of those 3 criteria, or you just have 30 years of service, you are what the company considered pension eligible, service pension eligible. And as a result, you will get a pretty large uptick in your pension once you reach this milestone. I always encourage people to go into the Net Benefits website and the pension modeler first, you need to figure out when you hit that milestone, and we can help you if you're not sure how to confirm whether or not you're going to be mod 75 or when you reach that milestone. And then to see what the advantage of reaching that milestone is, run a pension projection for a month before you reach mod 75 date, and then just after you reach your mod 75 date. And most people see over $100,000, sometimes several $100,000 increase on their pension after that milestone has been met. A lot of people, that's the earliest they will even consider leaving AT&T. There has to be a pretty good reason to leave the company before that date. Unfortunately, we've seen a lot of people leave the company involuntarily before that date. This is one of the benefits, one of the many benefits of running a cash flow analysis, is to see ultimately what do you have to do if you lose your job prior to mod 75 to get back on track with your retirement plan. And then for those that are fortunate enough to meet this eligibility requirement and get the big increase in their pension, then we could see, well, how advantageous is continuing to work even past that date, and what's the optimal day to leave so that I maximize what I walk away with and minimize my risk of running out of money in retirement or outliving my retirement assets. Now, as it turns out, life expectancy, like I mentioned earlier, plays a role in the pension payout, at least as far as the lump sum is concerned. The younger you are, the larger the lump sum the company has to give you if all other variables are held equal. For instance, somebody who's 55 years old with 30 years of service is going to have a bigger lump sum than somebody who is 60 years old with 30 years of service, all else held equal, such as their salary and which pension plan they're on. The reason is because our life expectancy, as we get older, our life expectancy gets shorter. And if we were to take the pension as an annuity, we would expect to receive fewer annuity payments as we get older, which means the company also is able to give us a smaller lump sum the older we are once we start commencing our benefit. This is also a reason most people do not choose voluntarily to defer the election of their pension. Although it is an option, you don't have to take your pension right when you leave the company. In almost every scenario, it does not make financial sense to do so, typically for two reasons. One is because in some cases, your lump sum is actually declining the longer you wait to take your pension. And for the more obvious reason, you might as well be earning some interest on that money while you wait to spend it. So there is an opportunity cost of having that money locked up in the pension plan. And especially now that we're in a little bit higher interest rate environment than we were in certainly 2 years ago, that opportunity cost is higher. Even in a safe environment, you can earn a lot more interest than you could have a year and a half, 2 years ago. So this is why the timing is critical, not only on your retirement, but when to take your pension. We certainly want to look at the tax implications, whichever option you're taking, whether taking your pension as a lump sum or as an annuity. And then ultimately, when we find out what option we think is going to make the most sense for you and your family, then we could start backing into what investments might be appropriate to recreate that paycheck once the paycheck stops at AT&T or whatever job you decide to move to after you leave AT&T, if AT&T is not your actual retirement. Now, we talked a little bit about this earlier. Higher interest rate mean lower lump sums on almost all pensions. Not all pensions at AT&T have this relationship with interest rates. The cash balance plan specifically does not, but most people are on what's called a defined benefit pension plan, where when interest rates go up, the lump sums go down. And a good rule of thumb to remember is for every 1% increase to interest rates, you could expect about a 10% drop in your lump sum. We actually saw interest rates go up almost 3% last year, more than 2.5%. So we saw many people losing 25 to 35% on their lump sum overnight at the turn of the year. This change happens on January 1st, but it's actually the November interest rates that will govern lump sum payouts for the following year's pension recipients. So for instance, if you left the company and took your pension by the end of last year, the company was giving you the November 2021 interest rates, which were substantially lower than the November 2022 interest rates, which are now the interest rates that affect anybody who takes their pension this year. And a reason many people left the company earlier is to avoid a substantial drop in their lump sum. Now, as it turns out, the rates have dropped just a hair since November of last year, the rates that are relevant for this year. And the IRS updates these interest rates on a monthly basis, and we can actually watch these rates throughout the year in preparation for giving advice to people on when's the best time to leave and take the pension. Last year, we were telling a lot of people who were close to leaving the company, you might as well leave now if you're planning on taking a lump sum, given the amount of money you stand to lose. There was also people that were concerned about job security going into the end of last year. In fact, we've already seen some reductions in force and are actually going to see a lot more as a result of the company looking to consolidate operations in a variety of different cities around the country and forcing people to move if they want to keep their job. Not everybody's affected by this, but we've received a lot of calls in the last couple of weeks based on folks not being able to or not wanting to uproot themselves and are probably going to leave the company this year as a result. Now, while these interest rates change on an annual basis, this is one of the risks that we face while staying at the company, as well as one of the risks we face while leaving our pension with the company if we have already left employment with the company. I'm going to zoom in here on these interest rates because we saw in November the rates, actually you can see the second segment rate, this middle rate here, went up 2.88%. By a rule of thumb, that's a close to a 28-29% drop in pension. You can see there's two other rates here, the first and third segment rate, or the first and third column here, that aren't as relevant in the calculation. They don't carry as much weight when the company is calculating the lump sum, but they still carry weight. And all three of these went up pretty substantially. Historically, the highest interest rate increases I have seen in my entire career with the company. When we started in the early 90s at the retirement group, there were a couple of years with big interest rate increases in the 90s, but none of them in the history of our company, the retirement group, since the early 90s, have we ever seen a year where rates jumped so much and reduced lump sum payouts so much. And like I mentioned earlier, rates have dropped a little bit since November. So key takeaway here, if you're somebody who leaves the company this year, you want to pay attention to these rates because you may want to consider deferring the election of your pension, if only by a couple months. Because let's say you leave the company in September and rates have dropped dramatically since last November, you might anticipate a large increase in your lump sum come January 1st when the rates are updated. Now, there is never any guarantees with this, and a good reason to follow these rates closely when they update them on the IRS website every month. Let us know if you're not sure where to find that, or you can just call us or just stay tuned on these webinars. We'll be giving updates. But for those of you that are considering a lump sum, this is critical. It could mean tens, if not hundreds of thousands of dollars more or less in your retirement plan, which can really make or break a retirement plan. So keep a close eye on these interest rates and make sure you understand how they impact you specifically in your pension plan. So let's talk about some of these pension formulas. So we have this cash balance plan. Many employees have this plan. This was frozen back in 2005. So folks that had a cash balance plan were given a CAM plan at that time, but they still have both pensions. Unfortunately, you do not receive both pensions. You will receive the better of the two pensions. And here we are in 2023. There's very few people where their old cash balance plan exceeds the value of their CAM plan anymore. It used to be relevant because it used to be that most managers could not take a full lump sum. It wasn't until I believe 2016 that the company started offering full lump sums. Prior to that, there was a partial lump sum with residual annuity. And that partial lump sum was calculated based on the value of the old cash balance plan. In fact, that is still an option for most managers, partial lump sum with residual annuity, where you take your pension in part as a lump sum and in part as an annuity. Can make some sense for a lot of people. And even the full annuity now is, we've seen, a little bit more attractive for those that, maybe you're comfortable keeping your pension with AT&T the rest of your life. You're expecting a long life expectancy. Maybe you don't have beneficiaries that you're concerned about losing out on the estate planning benefits of the lump sum. Maybe you're ultra conservative and you don't have interest in volatility on your investments or the ups and downs of the market. There's a lot of reasons to consider annuity, but there are still a lot of folks that we talk to interested in taking their pension as a lump sum, even though the lump sum payouts are substantially lower. The silver lining on that is that interest rates are higher, so you could produce a higher income stream in a low risk environment than we could have 2 years ago. And that is, in fact, why lump sums go down when interest rates go up, is because the present value of that cash flow stream is higher when interest rates are going up, because we can just produce a higher rate of return on our money. So this cash balance plan, although frozen, it does still grow by the 30-year treasury every year. And that's why I mentioned earlier, higher interest rates are actually good for the cash balance plans because they're growing at a higher rate moving forward. Now, the career average minimum, or CAM plan, what they did when they came out with this in 2001, they made anybody who was hired prior to that date immediately eligible, but now you have to be employed for 3 years to become eligible, or you have to be vested to get this pension plan. It's changed several times since they came out with it. And what the company does is they take your average compensation from 1995 to 99, they multiply that by your years of service, what used to be NCS, but is now term of employment, or TOE, up to 1999, and then they add on your post-1999 compensation. Then they get this average career income figure, which they multiply by 1.6% up until service through 2021, and then they reduced the accrual after that point. So any years of service you have beyond 2021, they're actually only multiplying that by 1%. In other words, your pension is growing at a slower rate, anybody who's on this CAM plan now, compared to what it was growing at prior to the end of 2021. We don't anticipate the benefits from AT&T are going to get better over time. We actually anticipate the opposite, as this is what we have seen in the last decade working with folks. And, this is no knock on the company. The company has had its challenges. Whether or not you agree with management decisions being made, the point is here that we make sure that we put together a sound retirement plan and maybe pivot on some of our original plans where we anticipated a higher pension payout. Maybe that means we need to save more in our 401k plan. Maybe it means we need to work a little bit longer. Maybe it means you work somewhere other than AT&T. There are a variety of pivots that we can do in an effort to put together a more sustainable retirement plan, but just knowing where you stand and what you need to do to get to where you need to be is where we feel like we can add some value in this process. Now, there is age penalties on the CAM plan. We talked about the big detriment of not becoming Mod 75 as it pertains to pension payouts. However, even if you do get Mod 75, there is a chance you still have age penalties, effectively if you are not yet 55 years old. So for instance, you could be 50 years old with 25 years of service. You've hit your modified 75 criteria. However, you still have 5 years of age penalties. And so this is also in some cases a reason we might encourage somebody to defer the election of their pension, because you can still age out of age penalties even after you leave the company. And especially the instance of somebody who meets their Mod 75 before they are 55 years old. And we've especially now been talking to a lot of people where that's the case. Rather than moving to Dallas or New Jersey or Atlanta, I'm going to get another job and I don't need the money, so I'm going to wait to take my pension because I'm not yet 55. The way to make that evaluation is to figure out what your growth rate is on your money from the time you leave the company until age 55 is a good milestone to look at. Age 65 is the normal retirement age, although typically we find that the growth rate is so low that there is not a big incentive to leave your pension at the company past age 55 if you are no longer at the company. And then we compare that to what we could earn in something like a CD or a money market or even short-term treasury bonds. And now we at least have a good decision-making point to make a pretty big decision for a lot of people. Now, the age penalties, if you are under age 55 with less than 30 years of service, they're actually 6% a year for every year under 55 that you are. So think about that. If you're 50 years old, you have 5 years worth of age penalties at 6% per year. That's a 30% penalty. That might be worth waiting to take your pension, even if you leave the company before age 55. Now, if you meet your 30 years of service, but aren't yet age 55, your age penalties actually get cut in half to 3% per year and aren't so detrimental. And in some cases, that's not even worth waiting for, because now in a very low risk environment, CDs and money markets, most of them are paying more than 4% a year now, versus the 3% a year reduction in age penalties that you're receiving by waiting to take your pension if you retired after age 50, but before age 55. So just a lot to consider on the timing issues here, but pretty good alternatives now that interest rates are higher compared to what we were getting on our pension, certainly if we're not working at the company anymore. As you can see here, table B is what it's called if you retire without your mod 75. The penalties are very severe. This is why most people see an increase on their pension of $100 or several $100,000 once they reach that milestone. If you are, for example, somebody who's 54 years old with at least 20 years of service, that person would be only 1 year away from mod 75. But if they left and took their pension, they might only be walking away with 60% or 65% of their pension. So definitely worth knowing when that milestone is met and how much you stand to gain by meeting it, or how much you stand to lose by not meeting that milestone. Now, we've talked a lot about the lump sum. It's been very popular for a while, but it's not the only option, and each plan has different payout options. We talked about a partial lump sum with residual annuity. If you take your pension as a full annuity, there's even multiple ways to do that. You could take a single life annuity that pays you, the employee, for the rest of your life. That is the highest payout option. If you add a joint survivor onto your pension payout, the payout's going to go down. However, it's going to be good for, rather than just one lifetime, it's good for 2 lifetimes. Usually this is done with a spouse, but it doesn't always have to be. And there are different payout options. So for instance, if you take the joint 100% survivor and you pass away, your spouse is going to maintain the same amount of income after you pass away. That's the 100%. It's 100% of what you were getting during your lifetime. Your spouse will continue to get during his or her lifetime after you passed. If, on the other hand, you take a 50% joint survivor, there's going to be a reduction of income. It'll be cut in half for your surviving spouse. However, the benefit to doing that is you don't give up as much money on your payout per month while you, the employer, the retiree, is alive. So different strokes for different folks. It's in some cases a function of whether or not your spouse has a pension of their own. The age discrepancy is also a factor when deciding how much we're doing the payout on. Should we consider just taking a lump sum and recreating our own death benefit on the side? There's a pension max scenario where you actually employ the use of life insurance and can potentially get a better bang for your buck compared to what the company's offering you as a death benefit through the joint survivor. A lot to consider here, but we'll talk through this when we run your cash flow projection and run several different retirement scenarios, so you can start to whittle down these options a little bit and start to figure out what's going to be in your and your family's best financial interest in the long run. Now, there have been some changes. We talked about this earlier in the presentation. The company has done what many companies that we've seen do over the last several decades, is sold off some of the pension liabilities to an insurance company. Many of you heard this in the news in the last couple months. The insurance company that purchased these liabilities was Athene, and it doesn't affect all employees, but it affects about 96,000 retirees who were expecting to get their monthly pension for the rest of their life from AT&T. Now that payment is being made by an insurance company, Athene. For better or worse, we expected this to happen eventually. We are not surprised by this at all. We anticipate this will probably continue to happen. So those of you that are not yet affected by this, keep a close eye on this, because this is many reasons, a reason that many of our clients decided to take the lump sum so that they had control over their money and their future income, rather than a decision made by AT&T management that they had really no control over. So this is one of the biggest detriments of this, is that it's no longer covered for those affected by Pension Benefit Guaranty Corporation, or PBGC. There still is some forms of insurance on this money that's being paid out, but there is a possible risk of this insurance company going out of business and those retirees not being made whole on what they expected their monthly payout to be for the rest of their life. Now, those of you that did retire, if you're retired on today's call and you left and grandfathered in retiree medical eligibility, this did not affect that at all. The company is still covering your post-65 retiree medical or health reimbursement account if you qualified based on when you retired, and they're still offering pre-65 retiree medical benefits for those that retired to qualify for that benefit. Although if you're still working at the company, for almost all of you, neither of those benefits are available anymore. You had to have retired before 2020 and before 2021 were those years that they changed those benefit plans. So let's talk about some considerations for having a pension paid by a private insurer. So like we talked about, they're not protected by PBGC, but they are insured to some degree dependent on the state. So they have these state guarantee funds, a little bit different than Pension Benefit Guaranty Corporation. If Athene were to go out of business, these liabilities would be transferred to the state agency. Reality is most people would still have a pension, but some people would have a reduction in their pension amount, which could be completely catastrophic for a lot of people relying on these pension payments and Social Security for their income. This is one of the reasons we encourage people to be as self-reliant as possible. Do the best you can to save in your 401k and in outside buckets where you can. Be as tax efficient as possible, because not everything's under our control. And the more control of our own destiny we have, the better probability of success we're going to have. So here's some concerns that we've heard from a lot of people, and really some concerns that we at the retirement group have as well. Athene Holding, they reported a $1.1 billion loss in Q1 of 2020. Federal Reserve Board cited Athene as potentially vulnerable to stock market fluctuations. Pensions taken over by private insurers like Athene may carry inherent investment risk that might not have been carried when the liabilities were held within the AT&T pension fund. And employees relying on pension should face financial uncertainties if the insured face financial troubles or bankruptcy. Now, there's still risk if AT&T was to go out of business. If you take your pension from AT&T, even PBGC might not fully back the payment that was expected or promised to you by AT&T when you originally retired. But just one of the risks, if you do not take your pension as a lump sum, if you take your pension as an annuity, you could be subject to a company not doing as well as you had have hoped over the next 30 or 40 years that you're alive. And that is a long period of time to be guessing at how successful a company is going to be, whether it's AT&T or Athene or some third insurance company. These are risks that we face when we're stuck in a payment plan from any company. Now, we've talked a lot about this throughout the presentation, but we think it's critical to put together a plan for your retirement. Unfortunately, statistically, they say that 74% of Americans over the age of 50 don't even have a written plan for their retirement. This is absolutely unacceptable, folks, especially when a company is going to do this for you on a complimentary basis, completely for free. The retirement group, there's a lot of companies that'll do this for you in an effort to get to know you and let you get to know them, in an effort to earn your business. We're hoping that you consider doing some business with us, although there's also no expectation by going through this plan with us that you do any business with us. All we ask is if you find value in going through this exercise, maybe just refer us to a couple of your coworkers who might also find similar value in running a plan with us or having us manage a portion of their retirement assets once they leave AT&T. There's also a lot of ways that you can do a test run of our services, or really any company that you might be considering working with in retirement with a smaller amount of money before you actually retire. And we've seen a lot of success stories with that. A lot of people have appreciated building a track record with a company prior to all these big decisions that come up in retirement. So if that's something you're interested in, let us know so we can talk to you about how that works, what the costs would be, and what we might recommend for the investments to complement the investments you already have in your AT&T 401k. Whether or not you have an advisor, we think it's important, if not critical, to get a second opinion, meet with several different companies, see who you like the best, see who you communicate with the best, who is giving you the best advice, who do you feel like has your best interests at heart more than the others, who has the lowest cost relative to the value you're getting. You probably don't want to work with the most expensive advisory firm, but you also probably don't want to work with the cheapest advisory firm either. It all depends on cost relative to value. You've got to be getting something out of this relationship if you're paying something. Test run's a good way to do that, but just scheduling a couple meetings, having us do a cash flow analysis, having us do a 401k review, looking at your allocations. In going through a couple meetings, you're going to know pretty quickly if it's not a good fit. And if you think it might be a good fit, then you continue the conversation. Worst that can happen is that you find this exercise a waste of your time, and we certainly value your time, so we're going to try our best not to do that. But worst case scenario, you verify you're doing everything that you should be, and at least now you could sleep better at night verifying with a team of professionals that has a lot of experience working with AT&T employees that you're doing what you should be. Best case scenario, we point out a couple flaws in your thinking or a couple things to consider, and you improved your retirement plan and probability of success as a result. So if that's something you have interest in doing, whether it's scheduling a phone call with us, a web meeting, an in-person meeting, whether just to answer a few questions or to actually have us build this retirement analysis for you, you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. You could take a picture of this QR code to get on to one of our AT&T focused advisors calendars. And last but not least, our LinkedIn page is where we publish these webinars so that you can view some of the topics that you're most interested in at your own leisure. With that, we're going to wrap it up today, but we do have some time for questions. So Sam, if we have any questions, now's the time. Let's ask them and we'll see if we can get to them.
Yes, Tyson, we had a couple questions come in. The first one, can you provide a detailed explanation of the changes that have occurred as a result of the pension being transferred to Athene?
Okay, yeah, that one probably came in before we covered it.
Right.
Essentially, a portion of the company's pension liabilities, it's less than half of the pension liabilities, but it was a pretty good chunk. If I remember correctly, it was close to about 20% of the total pension liabilities. AT&T looks at retirees as a liability that they have to pay over time. And that liability was sold off to Athene. And so now Athene is responsible for paying these folks that are affected, which is many existing retirees, pension payments. So now the direct deposits are coming from Athene rather than AT&T for the rest of that person's life, unless Athene decides to sell those liabilities off, or if Athene goes out of business and it goes into PBGC. It doesn't affect most employees. Like I mentioned, I think it's about 80% of the liabilities are still on AT&T. If you're still working, most likely you are not affected by this. But if you're on this webinar, most likely you're still working with the company. And the reason we're talking about this is just one of the considerations. If you take that lifetime annuity from the company, it's a lifetime decision and it's really out of your control beyond that point. So make sure to do your due diligence when running your plan and compare very specifically the lump sum versus the annuity and what risks you stand to take, whichever route you decide to go on your pension.
Thank you. Number two, what does this change mean for our coverage from the Pension Benefit Guarantee Corporation, PBGC?
It means it's gone. For those of you that are now under Athene's umbrella, you no longer have a PBGC insuring that pension payment.
Wow. Number 3, how can I stay informed about the financial health of Athene Insurance?
Yeah, good question. There you can go through Athene's website. Athene is an insurance company, a private company. Privately, they're a publicly traded company, but it's a private company. You can go to their website and find out information on their credit rating, information on their their balance sheet, information that you would want to know that they're a sustainable company, that they're not running the risk of going out of business, which is the worst case for somebody that's getting their pension from them. So I would go to Athene's website, and you can also just do a Google search to look up information for Athene. Is probably a good way to get information.
All righty. Last one. Who is the reinsurer affiliated with Athene Insurance, and how can we evaluate their financial stability?
Oh, that's a good question. What I know about Athene is they have multiple reinsurance companies. And what I would recommend is, again, if you look through on Google, just do a Google search for Athene ratings, Athene reinsurance. This will come up with what type of insurance, the state level insurance that we talked about, that Athene is offered in the probably low probability that they go out of business, but certainly a possibility, especially if you've got 30 plus years to be relying on them for your pension payments. Might not be a bad thing to know.
All righty, Tyson, that was all of the questions that we received this afternoon.
Great. Well, listen, thank you, Sam, for helping me out today. Thank you, folks, for joining our webinar series today. Everybody have a good rest of your week, and we hope to talk to you all very soon.
Thank you, everybody. Thanks, Tyson.